M. Kamakoti. He is the Managing Director and CEO at City Union Bank, about the same. Good to have you on board and good morning. To begin with, Mr. Kamakoti, there have been concerns from the analysts as well as the industry experts in terms of the rising stress in the SME book. As an industry player, are you seeing the rising NPA stress for the SME sector? Can you just put that into perspective?
See, there is a lot of opinions expressed about them even after the demonetization, after the introduction of GST, as if there was no future or tomorrow for the NBFC sector, the SME sector per day. And many of the analysts and all, they are being pointed out, and a lot of reports and dreams of papers are written that their ratios are not looking too good, and after analyzing so many published numbers and all, things are not taking a shape and all. But we have to, even though the data that are being discussed are quite okay, in terms of how you choose or how you interpret those data, it has to be properly looked into. Repeatedly, we are also facing questions on because we are one of our main breadwinner is SME sector, and we are also quite concerned, and we are following it up closely. First of all, I want to say that things are not as bad as it is perceived or as bad as it is being made out to be. When you analyze a larger company and when you analyze an SME, there are multiple ways of looking at it. Not that all the SMEs, you will always see 25-30% growth year after year, and making a lot of profit, and making an exponential growth rate and all. By and large, most of the SMEs, like say, they have a sustainable business model where the growth rate, profitability and all will be in a moderate level, and they sustain for a very long period of time. If you look into the basis and also take it from our own experience, particularly we typically used to we have seen decades where our slippage ratio used to be about 1.25 to 1.5. When we have a 1.25 to 1.5% slippage ratio every year, we used to have typically our SMA2 ratios at least 3 times of that number. In other words, about 5 to 6% will be our SMA2 numbers, and we will be typically having about 1.25 to 1.5% slippage. We faced a huge increase in that number way back in 2014, when we saw the SMA2 ratios even getting into the double digits, and we had a couple of years when our slippage ratio was touching even 3%. From there, it has moderated to somewhere between about 1.9 to 2. We feel if you look into the pattern, in fact, a lot of concerns were raised after the demonetization and all. Things are not as bad as it is being perceived. It is quite okay.
Okay. You have a 30% exposure to the SME book and 15% is the agri book. However, while your Q4 NPAs rose, are you seeing higher proportion of stress actually coming down from the SME and the agri book in FY20?
See, when I say about my NPA numbers and slippage, it is basically to the percentage of my closing advances for the year as a whole. You will always be having quarterly aberrations when a few quarters the numbers will look increased, and there will be some quarters where the numbers will be subdued. Which is you will not be having what you call straight, smooth flow of slippages or recovery. What I can definitely say that though there could be quarterly aberrations here and there, year as a whole, whatever we have been hoping that incremental slippage as a percentage of the closing advances for the current year as an as varies condition, we don't expect to be worse than last year, and it should be slightly even better than whatever we had last year. There could be always quarterly aberrations, and we don't expect any major shock based on the data whatever we have at this point of time.
Enough. Now, nearly 63% of your loan exposure is to Tamil Nadu. Do you think that the delay monsoon will impact your cash flows of your customers and lead to higher NPA stress going forward?
See, these sort of aberrations probably like whatever we are facing today in terms of deficient monsoon for the month of June up to third week, we had the same pattern about 7 years back, and it is a cyclical thing which you see on now and then. Whatever I can see from the behavioral pattern of books and whatever our data suggests is that we typically used to have about 1.25 to 1.5% of the closing advances as our slippage, which almost went up to 2.93% way back in 2014-15 sort of. From there onwards, every year it has moderated to 2.8 to 2.3, 2.3 to 2.2, 2.1, and currently it is about 1.9% of the closing advances. The behavioral pattern, whatever we see at this point of time, and our expectation is that there could always be quarterly aberrations, but overall we don't see, we don't expect the incremental slippages to the percentage of closing advances of the current year behaving significantly different from whatever we saw in the last year.
Okay. Now, you've guided for an 18 to 20% loan book growth. How do you plan to achieve this, and how would your product mix look like?
As you rightly pointed out, the combination of SME, commercial trading and agriculture sector together, they roughly constitute about 2/3 to 3/4 of our loan book. And we don't expect any major changes in the credit composition or book composition, whatever we have seen in the last year. We are not pressing the growth pedal too much. We are just floating with maybe 3-4% over and above the growth rate of the industry or slightly bigger. Though you are not seeing rivers of milk and honey flowing, but overall situation is pretty okay and not as bad as it is being made out to be. We are quite comfortable, and we expect the overall numbers to be in tune with the past trend, whatever we have shown so far.
Okay. One of the positives for your bank has been that margins have been largely steady in the last 8 quarters. What really led to this kind of performance, would you say? And do you really think margins hold through, or do you think they're going to come under pressure come FY20?
If we analyze last 50 quarters of our margin trend, for about 45 quarters, our average net interest margin had been between 3.4 to 3.7. The net interest margin above 4 has happened only in the last 7-8 quarters. And depending upon the proportion of our loan book, which is on the floating rate and things like that, we always had a pattern when our margin used to expand when there is a growth in the, there is an increase in the interest rate cycle, and there used to be the margin contraction when there is a decline in the interest rate cycle. But in the last cycle, it did not behave in that way we expected, or it has been behaving over a period of many cycles. Mainly because there were supply side constraints, because many public sector banks did not have sufficient capital to grow, or their growth was subdued, and currently you have some sort of moderation in the NBFC growth because of so many reasons. And the supply side issues of credit perhaps probably was one of the main reason where we could also see the interest rate deposits rates and all also behaving in a different way compared to the expected interest rate cycles. So we are always keeping our fingers crossed and expecting moderation in the margin for the past 3-4 quarters, particularly since the beginning of rate cut by the central bank. So far rates have been holding, and we have to wait and watch, and we have clearly communicated the amount of net interest margin whatever we are seeing so far. We cannot share 100% confidence that these are all sustainable levels, and although we are taking our best efforts to manage the margins and things like that, we also need to keep an eye on the movement of the interest rate cycle.
Just wanted to also understand, as a bank, By how much have you reduced your deposit and lending rates so far, and how much more of a reduction can we see in your deposit and lending rates in terms of the monetary policy transmission?
Our deposit interest rates, like say we had a special deposit where we were offering about 15 basis point more for the 1 year, about it was 400 deposits which we have withdrawn. The other monetary transmission and all, we are just waiting for the market to react. We expect overall, both on the deposit side and also on the lending rate, there could be at least a 25% adjustment to the overall rates, while to what extent it will directly affect the margin is something which you have to keep and watch, and I think it will take some more time for the entire thing to be seen exactly into the overall net interest income and net interest margin.
Okay, great to have you on the show. Thank you so much for taking the time out and really highlighting how the economy as well as your business per se is shaping up.